Good afternoon, ladies and gentlemen. Happy Friday, the 13th, July 13th, 2018 to you all. Welcome to today's presentation, our Friday open forum Q&A session. For those of you who don't know me, my name is Mike Chupka. I am the Director of Education here at PowerOptions and at RadioActive Trading as well. Before we begin, we just want to start off with, well, what is PowerOptions? PowerOptions is a patented suite of search and analysis tools designed for self-directed options investors. We also have tools to further research and analyze the stock or the option, a whole set of signature tools for further analysis into things such as volatility skew, volatility curve, long option finders to find the best long call for your position or long put based on your expectation of the stock. Other tools to help you analyze and research a position, and of course a full set of portfolio tools to track and manage your positions and evaluate rollout opportunities or adjustments as well. Of course, in addition to that, we do offer countless help videos, articles, white papers, and archived webinars to help you not only get familiar with the tools on the site, but the various option strategies as well. Ernie created the PowerOptions tools back in 1997. Everyone here on staff, myself included, use these tools to trade our personal accounts, so we have many more years of combined trading experience. Now, our process and procedures for this afternoon's presentation for our Friday sessions. When you logged on to the webinar, GoToMeeting, GoToWebinar platform appeared on your screen. Inside that platform is a question pod, so just use that question pod to send us a question at any time during the presentation. Please feel free to ask as many questions as you want. Now, we're scheduled to be here from 4:30 p.m. to 5:30 p.m. Eastern Time, but if we have a high volume of questions, we'll be more than happy to stay online to make sure all questions are handled. Your questions can really be about anything related to options, questions about general option strategy. Maybe you're interested in the proper structure of a debit spread, credit spread. You're interested in calendar spreads and just getting started, want to know what kind of structure you might look for. You, of course, may have questions about trade management. When is it a good idea to roll a covered call, a diagonal spread? What should you look for when adjusting a bull put or a bear call credit spread, or an iron condor or a butterfly as well? You might have questions about option specifics. What is delta? What is gamma, theta, vega, or even the basics? What should I look for range-wise out of the money when selling a naked put or doing a type of maybe short straddle or short strangle, I should say? Of course, you may have questions about the tools on PowerOptions. That's all fair game. Or concepts of the limited risk radioactive trading techniques. We'll handle all of those as well. Our basic ground rules. Don't be shy. Please feel free any questions that you want at any time during the presentation. Be patient. There might be one or two questions ahead of yours, but as I mentioned, we will get through them all. We do have one or two questions that came in sort of via email in the beginning, so we'll take those real quick, and then we'll get to the fresh live questions coming in. I also encourage you to feel free to help us help others. If a question comes in, I give a response based on my market experience, conversations I've had with other PowerOptions users or investors, or what I've done in my personal account. But you have a different way of analyzing a position, managing a certain structure or a certain type of trade. Share that with us with the question pod, through the question pod, and we'll share that with the audience as well to help us help others. I may ask you briefly for clarification on your question, just to make sure I'm looking at the same thing and I'm analyzing the same type of strategy that you're asking. There's a lot of names that are thrown out there, a lot of different structure names and marketing names for a simple strategy. So I want to make sure that I'm looking at the best possible structure and that I have all the numbers right and the structure right to analyze. Most important, let's have fun. Let's get some good education under our belt and get ready for the weekends. And then, of course, get ready for next week as we head into standard expiration, of course, for the July 20th series. Now, I am going to navigate over to the PowerOptions suite of tools. Perfect, okay. And what we're looking at here, of course, is just the basic format of a 14-day free trial. For those of you that are just getting started with PowerOptions, I encourage you to follow step 1, step 2, step 3, and step 4 to get more familiar with the tools on the site and the various option strategies. Now, I'm going to go right to our custom spread tool, which just allows us to build positions on the fly to see the risk graph analyze what-if scenarios and more. And this is for Khokon, who sent in me an email earlier related to a position he has on AXP. Now, the position for AXP, I'm going to go to the view options here for the July 20th expiration. And what he'd done, Khokon has done, is a while ago he purchased a 99 call for about 263 and sold a 104 call for 55 cents. So this typical structure is a bull call debit spread. It's got about a 5-point difference. So if the stock is above both strike prices, is above 104 at expiration, essentially he'll buy shares of stock at 99, sell them at 104, and get $5 back. And at this point, he only has a debit of about 208. So it's a possibility for 292 or so profit. Oh, sorry, folks. Hold on one second. There we go. I apologize. I had to refresh the page there, and it didn't quite make it. Okay, so let's go ahead now. Here's our bull call debit spread structure. Bought a 99 call. We have sold a 104. As you can see up top there, we have a basic debit of 208. So if we close out for the maximum gain above 104, we'll get 5 points back, so a max profit of 292. However, stock has to move 4 points from where it is today. It actually closed higher than when I looked at this position this morning. But it has to go above that. Now, in addition to this, Khokon decided to get extra premium by selling an out-of-the-money put against this structure. It's not covered by the long call. It's not covered by the short call. It's a naked put. But the 94 strike for the same expiration, 94 strike put, obligates him to potentially buy shares of stock at 94, and he received at the time 42 cents. All right. Now, this changes the dynamic of the spread a little bit, so we get an extra premium on the position. Okay, just taking a look there. All right, sorry about that. I was looking at a question further down that's related to the custom spread tool, but it's not related to this. We'll get to that in just a moment. Anyway, here is our bull call debit spread, but now we've got an extra naked put. The risk is now very drastic because if the stock continues to fall, we lose more on the naked put side. However, we increase the potential profit to 334. It only shows a 3.5% return because we have to put up the margin to cover the position. In any case, what Khokon wanted to know is what are the outcomes of this position going forward if he wanted to close the position early and not hold it to expiration. Well, we lowered the debit to 166, so the break even at expiration when all the time value is gone from the three options would be 166. Right now, it's still going to cost something to buy to close this call. It's going to cost something to buy to close this put if you liquidate it, and although we have a gain of almost $1, 85 cents or so on the long right now, we might not get as much profit as we're expecting. We won't really get the full max profit of this position until the time value of the two shorts gets closer to 0 and decays out. But on the custom spread tool, we can go ahead and account for that. We can take a look and say, well, what happens if the stock is near our break even on Monday the 15th? I'm sorry, the 16th. Okay, assuming volatility stays roughly the same for these near-term options. So in this case, our long call would be worth 198. It might still cost us 12 cents to buy to close the 104, and maybe 3 or 4 cents here to buy to close the 94 put. We only have about a $20, maybe $15 gain. We need it to move higher to close early. But if the stock is at that same price on, let's say, July 19th, we have a loss because even though the time value is decaying further, we're also losing time value on the long call as well. So this is a gamble. It's not a gamble, my apologies, wrong term. But this allows you to see what you'd expect to be, and unfortunately, with Khokon's position, by Monday, if he's expecting double-digit returns, not including the margin for the naked put, of course, but you're probably going to need the stock to be closer to 101, maybe 102 come Monday or Tuesday in order to have value here and still see time decay on the two short options, the short put and the short call. Right now he's just about at break even, not at a gain, even though the stock has moved up slightly. All right, so that's the bull call debit spread, a little naked put mixed in as well. Now, while I'm here, okay, let me just scroll down here. Good. While I'm here, we had a question come in from Dwight, and he says, how do you account for dividends expected to receive when running what-if scenarios on this custom spread tool while we're here? Dwight, I would potentially just add it in. Let me take a look at something very quickly here. I'm just going to go to my portfolio. All right, so I'm going to go to my portfolio. I'm going to take a look at the portfolios. Some of my positions here. I'm going to click on the important dates. I know which ones do. I don't know if one's coming up soon. Let's see. Oh, okay, so I passed 43 days ago with Interactive Brokers and 37 days ago with PHM. Okay, I'll use IBKR. It's probably coming up in 20 to 30 days. Interactive Brokers, small dividends, 10 cents, annual dividend of 40 cents. Not a lot, Dwight, but a little bit. Okay, let's go back to the custom spread tool. So let's say about 20 days from now, we know we're going to receive 10 cents for a dividend. Well, if I'm doing just a near-term covered call for August, let's say you bought the stock the other day, 100 shares at 60.50, and I sold it just out of the money August, well, at the money, 60 call. It's going to be slightly in the money. All right, so it's a 35, 40-day trade, 4.7% covered call return. Or if I'm in a married put, of course, I'd have a risk of maybe only 4.55% or so. Now, I know that in this covered call, I'm likely to cross a dividend. So to account for the 10-cent dividend, I am just going to lower the cost. I'm just going to lower the cost basis of my shares by the 10 cents I'm expecting to get when I cross the ex-dividend date. However, what I have to keep in mind, of course, with Interactive Brokers at 61.47, if the ex-dividend date is 20 days away, my 60-strike call is 35 days away, and IBKR happens to be trading above $60 on the ex-dividend date, I may get assigned early. So I'm not going to get that 10 cents. Okay. Oh, I'm sorry. It was 60.40. I put 60.10. It would have dropped down to 60.40. So yeah, we get up to a 5% taking in that extra 10 cents there. My cost base of 60.50 got the 10 cents. Just account for it taking off the price. You could add it to the premium too if you're doing a covered call. But if you're doing a collar or a married put, I usually just take it off the stock price myself. Which is an easier way to look at it. Now, if this was a married put and it was 5 to 6 months out in time, a RadioActive trade, and I knew I was going to cross two earnings, I'm sorry, Dwight, 2x dividend dates, I would lower this by 20 cents and put my cost base at 60.30 to already calculate how it's would help my position, what amount of risk would be lowered by adding that in there. Remember, Dwight, at any time when you're looking at a stock, you're using the custom spread tool, you can use the Edit More Information button here to just go to Stock Research. And right in the center here, it shows you the last expected dividend, the annual dividend percentage as well, so you can get a gauge, and of course, when the last ex-dividend date was. This one actually won't be probably till 8:30. I apologize. So if I sold a September call, then I'd lower my cost basis by 10 cents. But on the research tool, you can see the numbers very quickly. Just take the dividend off of the stock itself to calculate the increased return, or to do it that way as well. Okay, that's the way to do it. And Rhajiv says try forward for the dividend. It comes in 10 days. Okay, well, it's just, you know, anything you'd look at if you're doing a covered call or a collar, we would do the same thing. I'd build the covered call or collar for Ford. I'll just do that real quick. It's not, this position is not comparable. Ford is usually not good. I phrase it that way to do a collar. I haven't seen good returns with them. So let's say if I got into it today at 1097, Rhajiv, we've got 10 days to the dividend, so I'm ex-dividend date, I'm automatically going out to July or to August 3rd. Let's go to the 27th. I'm going to sell an 11 call, buy a 10. So it would be a standard collar out to the 27th of July, cross the ex-dividend in 10 days. It's only a 1.5% return, still taking on a risk of 7.7. That doesn't look too good. I don't know Ford's dividend, so what do I do now? I'm going to go to stock research. Coming up on 725. Oh, sorry, that's the wrong one. Last dividend was 15 cents. Okay, so assume we'll get about that price. So it should be coming up on 719, roughly. Rahjiv says 10 days, so it's coming up in that time frame. So I'm going to take 15 cents off of my stock price. All right, so 1097. That drops us down to 1082. Okay, so I take this up to 2.9, lower my risk to 6.5 on my standard collar position. Not too bad, but remember, if it goes above 11, we're right at the front door, right at the money. If it goes above 11 on the 19th or the 25th for the ex-dividend, I might get assigned. And now I'm not getting 2.9, because if I get assigned on the ex-dividend date, I don't get that dividend, date of record. I'm out of the position technically, so not on record of holding the stock. I don't get that, so my return would go back to 1.5%. Okay, Sam, quick comment here. And Sam, that's what I'm waiting for. I'll show you something in a minute. Sam says earnings is on 7/17 when we were looking at IBKR. I wasn't recommending a covered call on IBKR, by the way. I was just using that as an example to illustrate the dividend. I just knew it was one of my two dividend-paying stocks that I have in my portfolio right now. I should say with the RadioActive Trades. And you said as if the earnings are a blowout, then it could fill the $20 gap to the 80 target. Yeah. Side note real quick, the position I'm in for Interactive Brokers, this is it. It's a very low risk. This stock, I should have done something completely different with it. I didn't. No regrets. I have a low risk Married put at 1.5%. The cost basis on the stock about 75. Total cost basis $8,122. I rode this up from about $63 and all the way down to 58, and then it came back. But I'm still holding the 80 put. I haven't adjusted it. 2 months ago, I should have bought a 75 put, traded it like a straddle, would be at about a 12% profit right now. Could lock it in and bulletproof it by selling and close that other put and then just wait to see the earnings. Yeah, but I'm waiting for the earnings to come out on 7/17, see if we go up or down. If we go down, I can't lose more than 1.5%. I could bulletproof it with the call, but if it gaps up, then I give that back. So waiting on it for that one. All right. Now, okay, so we handled Dwight. And I've got to jump into, here we go, Bill. Bill asks, is there a formula to easily calculate the IV? No, we do it all in the background. I don't have a formula here. We do have Black-Scholes calculators, and you can plug in what you would want to see, Bill, if the volatility, you're expecting a volatility shift. For example, let's go to straddles. I'm going to just discuss this here briefly. So I'm going to go to long straddle. Okay, and there we go. Save configuration. My apologies. Let's just go to a search. Is this one of mine? No. Oh, weekly earnings. Okay. So what I'm looking for here is, oh, I could easily use Ford again, but that's probably not a good one. How about Whirlpool? Yeah, let's do Whirlpool or CTG. CTG, okay, Computer Task Group. It's an $8 stock. I could do a $7.50 straddle with earnings coming up on $7.19. Okay, now I know that if I bought this position today, this long straddle, let's take a look at it on the profit and loss chart. Very expensive. I'm paying 8 cents for the July 750 put, that's nothing, and 70 cents for the 750 call. The cost base about 78 cents to get into this straddle. Okay, so my upper break even is 827, lower break even is 672. Debit plus the strike at 7.5. I have a call and a put, hoping for a swing. But what I also know is that after the earnings come out, these volatility numbers are likely to collapse, meaning that even if I get, let's say, a 7% movement or 10% movement, I get 80 cents and it moves up to 9, well, I'll still have a profit just by intrinsic value. But if I only get a 3 or 4% movement, this only goes up to 850 or 860, these are also going to collapse. So my expected value is going to be much lower. Not lower here as far as the risk is. There is still infinite potential profit. But let's say come the 19th or the 20th. Let's put it on the 20th. The stock only moves up 30 cents from the earnings. It goes up to 850. But the volatility is cut in half. Drops down to 0.7. Okay, what would I expect? Well, I have a gain of about 22 cents. That's not too bad. Okay, this would still be worth $1, naturally, because of intrinsic value, so that would be okay. But if it drops 30 cents to 7.90, I'm only going to be at 40 cents intrinsic for the call. Right? It's not going to be inflated to 1.4. It's not going to remain at that high of a volatility there. Okay, you see, even if it did, we would just be close to break even. Let's go to 7.19. Yeah, so it still says 8 cents and 8 cents, but you're 1 day from expiration. This might not be the best example, Bill, but when I'm doing that, that's how I'll take into account a volatility shift. Now, as we did before, when I have my options on the chart, on the option chain, or here in the custom spread tool, I could go to calculators and I can go to the Black-Scholes and see what the values would be for changes in volatility. But we don't have an IV calculator where you plug in the numbers and then it shows you what the IV would be. I mean, it's taking into account those 5 factors: the stock price, strike price, days remaining to expiration, the current interest rates, and pretty much the SIV, or the 50-day volatility for the stock, is how IV is calculated with that equation. I think you can find one maybe for free at cboe.com if I'm not mistaken, Bill. So you can check theirs, check those volatility numbers. We just don't have the volatility calculated here. We do it all in the background using the various controls that are available to us, as we have for years as well. Okay. Let's see here. This looks like Rhajiv. Okay, he says, Mike, we discussed last time J&J. There was a judgment against the talcum powder suit. I saw that today, drop down. You took a profit earlier on Johnson & Johnson, Rhajiv, with 125 and 130 strike for the bull call debit. This Monday you created another position. What is the best strategies for this kind of lawsuit issue? I don't think it's that bad, meaning that, and others AT&T, what strategy will save these unnatural events? Was Johnson & Johnson really affected? That's what I didn't see. I saw the ruling come out. It was only down $1.83. That's not too bad. Okay. Was it yesterday that it was affected more? Let's take a look. No, it was up 152. So it's a complete wash of what the gain was yesterday with that drop. All right. It's still bouncing around this 125 to 128 range right now. I don't think that's going to affect it overly. I don't think that's going to be a negative. I don't think it's something you really have to worry about, Rahjiv, in this case. I don't think it's going to have much effect on the stock personally. And with AT&T, you know, there was a couple things there. Now, if you were in Papa John's, of course, that might have been a different story the last few days of the way that they bounced around. But again, you know, AT&T 56 cents here. I know you meant previously, but I don't think it's an effect. What happens is that you're playing for earnings mainly. This is a movement down, but it's the exact same movement down essentially you saw yesterday. So I don't think it's going to have too much of effect with these type of things. A pending patent lawsuit, let's say that you're in Sony, you're in Samsung or something, or maybe let's say you're in Apple, the reverse happens where Samsung sues Apple and they win and says all Apple products were based, I know it's not true and it's impossible because Apple was out first, but let's say that happens and Samsung sues Apple and says all of your products are based on this one patent that we've had back since 1981 to do this sort of algorithm, and everything that you do is based on it. So 10% of all the profits or 40% of all the profits you've received since inception in around 1983, 1982 belong to us, and they win. Well, naturally, that's going to kill Apple, but that's a whole different type of lawsuit. Things like Johnson & Johnson, unfortunately, Procter & Gamble, what's the other one? Bayer, I believe. They get these kind of lawsuits against this one kind of product in their whole mill of products, which caused a slight issue, and they have to do a payout, or they get sued for that, and they have to do a class action suit, unless it's huge, unless it's something so big that it affected so many people. These kind of smaller ones are almost commonplace for these stocks. In the case of Johnson & Johnson, I don't think it's going to have a big effect. I could be wrong. It could not sink in until next week, but it doesn't look like it had much effect on it at all. Okay, I don't know if this is a question, Rahjiv, but you said you created a bull call position on JPM 105 to 100. Oops, sorry. For a $100 credit, you're planning on doing it managing it, in 2 weeks. August 17, 105, 100. And this is a bear call. You say bull call credit, but this would be a bear call where I'm selling the 100 and buying the 105, unless you legged into the position if you're in a bull call debit. Now it's 385. Okay, let's put this at 430. So you say you got a $100 credit, and you're planning on managing it after a 30% gain, and you'll start doing it if it moves up to 105. Yeah, so I mean, no, I don't think we're in the right position. You said a bull call credit. So this is a bear call credit. I guess you did a bull call spread, but somehow you got a credit. You legged into it, and maybe you sold this at 430, but bought the 100 earlier when it was at 330. A bull call credit spread is normally not done that way. You would have had to leg into it. Yeah, so it would come out to a no-risk trade, essentially, because you've got a credit of 100, but you're looking for a 30% gain. And if this is the case, then you're already at full credit. So I think we've got the wrong one there. I think we've got the wrong trade listed. Okay. Oh, bull put. That makes more sense. Sorry. So that's why I like to clarify the terminology. Okay. Bull put. Very well. Let's do this real quick, and then we've got David's question here. 105, 104. And we got 100. So let's put in 150. It doesn't matter the numbers, really, as long as it's a dollar credit. All right, there's our bull put, similar to that bull call debit, but you're going to look for a 30% return on the position when the options decay out. So 723 if the stock stays at 106.36. The volatility numbers stay the same, around 17 or 19. I'm not going to have that much. Okay, so you're going to, if it drops down to 105, pulls back to 105 a little bit, you're going to be potentially at a loss theoretically, depending on where the prices are. I'd say that you'd need it to go to 108 by the 23rd, which is only 1 week away, and you said 2 weeks, so we might want to go further out. Okay. I'm not in the right, I am in the right options. Yeah, so $41, so that would be close to it. So about 107.50, 108 is probably the target there in the next week or two as well. Okay. Okay, so there's David's question. Real quick, David, I'm going to scroll through something, and I'll get to your question right away. Sam says, good afternoon. Was traveling the last 2 Fridays, back with some strong gains the past month. I'm just reviewing this real quick. So many shares up 30 to 100, small caps. Ford is doing nothing so far. It's a suggestion to Rhajiv. Instead of the Ford with the dividends coming up, check out CARB IQ. IECT. He says he's making a killing on those lower cap stocks there, CARB and IQ. And then, of course, he still has his positions on BA, CAT. Ooh, CAT was an interesting one. I'll admit that. And Amazon as well. Let's see. AOII, that famous one, is back too. So, all right. and SPY, Microsoft, and some of the Apple positions. Okay, so Sam, it's great to have you back. I'm sorry, I was just rolling through that. It was a good suggestion. Like I said, I'm not a fan of Ford for the premiums and because of the movement. It does pay a hefty dividend for the stock price, but it's not an overly great dividend. Carb, IQ might be other ones I'll check out as well. Look into those for smaller price positions. All right, David. We had a discussion last week about income method number 4, and David, I have some proof in the pudding for you for our discussion. I was hoping to get that blog or video done this week, but I was working on 3 other projects at the same time. So next week, I'll have insight for you and a little bit of comparison on the best time to use income method number 4, the best time to do it. But we were talking about radioactive trading last week with David. I'm sorry, folks. I may have to do something in just a second. I just misclicked something. In any case, David says we trade radioactively exclusively. Now you understand a cardinal rule is not to be in a covered call when earnings report will be released. That's usually my rule, and I broke the rule 3 weeks ago. In a sense, it was a covered call with another combination, and I missed out on 20% profit. Okay, not upset because I'm still at a 14% profit, could have been a 35% profit. Anyway, to the meat and the potatoes. David asks, are there any suggestions or guidelines when the stock has advanced past your short call? I'm sorry, would put you past, the stock goes past the short call before the earnings, you're looking to roll up, but in order to roll for a potential credit, you have to go past the earnings release date. Okay, I assume you just allow your stock to be called away. Not necessarily, okay, but there are options. And first thing, David, I want to go into is, some of you may or may not remember this. I don't know if you followed it. Mine was GOOS. Go to the custom spread tool. I think at the time, $43 on the stock price. I was holding a October, possibly 45 put that I had paid $425 for. This was close. It's not going to be exact. That's about right. 4.8% risk. Now, oh no, it's not. I'd rolled up from the 40 to the 45 put. I'm sorry. This was actually lower. This was about only 380. It was much lower than that. It was 380, but the cost basis was 41.50. After getting in, I think at 36, and the 40 put, rolling from the 40 to the 45, when I say 380, okay. So I had some small risk on the position at the time. Earning, yeah, when the stock was at 43. And I'm holding the 45 put, and earnings are coming up, but I still have this little risk here of 30-40 cents. So I did an income method number 5, which isn't the covered call, but it is in a sense. So what I did is I bought 45.47, bought 145 and sold 247s for that income method number 5. Okay. Now, real quick, I'll just get to this, and then I'll answer your question directly. And this was about $80. No, this was $150 at the time, and this was 95 cents. Yeah, roughly, something like that. Okay, so what did I do? I bulletproofed the position, and I left myself with a peak of an $807 profit, which was close to a 17%, 18% return if the stock was right at 47. All of my stocks that I've been in for 2 to 3 months with other radioactive trades, earnings had all been 3 or 4%. Goose opened at 59 after the earnings, so I'm still profitable, but I gave up all this value, $400, $500 on this position, or $4, $5 or so, from what the maximum could have been. Had I done nothing, of course, just would have gotten that extra $15, $16. Could have rolled up to the 55, had a 12% bulletproof position, liquidated about 20, I'm sorry, a 15% bulletproof position, liquidated about 22. Shortly after that, the stock went up to 67. Okay, could have done even better. What I did is I rolled one of my 47 calls up to 60. Of course, right after I did that, it went up to 67. I just held it, and it actually pulled back. I bought that call back when the stock was at 59.50 the other before expiration last month, and now it's still up at 60.27. So I'm probably going to do something else. But this was a interesting way to bulletproof it. I got the extra 2 points of profit from the 45-47 bull call spread now that the stock was at 60, but I gave up 13 points because of that call. That was the one that surprised me, and I was in the wrong position. To answer your question directly, what do we look for as far as rolling out if we're stuck in a position that's in the money and earnings are coming up? Okay, well, let's say that this was our new position after I bought that back for $12.80. So my cost basis moved up to 54 something. And then I rolled this put, this 45, got like $1 back for it, but then rolled to a 55 put. Okay, so was it 55? Yeah, no, this is about 52 cost basis after buying the call and taking the $2 back from the debit spread. That's just closer to only 11. Long story short, yeah, it's one at 380, maybe something like that. Okay, and in any case, that looks about right. It's a 1.8, 1.4% risk still remaining on the position. Okay. All right. Long story short, here we are. Let's say a few weeks ago, yeah, we'll just use this one. I had sold the 60 call for 75 cents while the stock was at 58. Now, here we are. It's not bad in this case, David, but it's above my strike price, and let's say I have earnings coming out next week. My personal opinion on this is rather than try to do an income method number 2, but it also depends on what your profit loss chart looks like. I'll get to that in a moment. If you're in something like this that you've lowered the risk a little bit, you've got earnings coming up, if you're sort of comfortable with the range of return on your graph, meaning that even if it goes up to 70, you're still making $600-ish. And if it drops down to 55, you're still making $600-ish, 550, okay? In that scenario, then yeah, you might want to leave this open. This is still a good area of profit. Now, is it worth it to roll up to the short call to go through earnings? See, that's tricky because I don't know your position, David. What I mean by that is if the cost to buy back this call is too high and I have to go to, say, 65, I go from the 60 to the 65 to a higher strike that's further out of the money, and I say, okay, well, I can roll that for a credit if I roll out to August from July, and I'll cross through the earnings. Is that okay? Well, what is your new profile? Now that you're at 65, are you comfortable if the stock is in this range? What if it jumps up to 70? What if it drops down to 55? Are you more comfortable with that position if you rolled for a credit? And you have to go 2 or 3 months out to roll for a credit. You might be at the 65 or the 70, so you still gave yourself some upside. But again, it depends on what your outlook is. What I'm sometimes tempted to do in these scenarios, by the way, if I think there might be an opportunity for a huge gap and I don't want to miss out on it, first thing, buy back the call. Don't roll it, just buy it back. And then maybe add a cheap put via income method number 12 to have a straddle going through earnings. Yes, it might cost me double. Yes, I'm adding, if I buy $1.50, I'm adding 75 cents back into this, well, because it's already counting for the 75 cents here. So I'm adding the dollar back in, $1.50 to buy it back, which will increase my cost basis, but again, still leaves the upside open. Okay, that's one idea. Could you just leave it as is, and if it gaps up, get assigned, and then get back into the position? Sure, you could buy back the stock at the higher price. I don't know how that would change your risk profile. Or you could try income method number 7 to get back into the position. That's in the blueprints, a way to get back in the position if you're signed with an income method number 1. Jamie asks, now, oh, Jamie says, what did you mean when you said you don't know his position? It might not look like this. let's say I did a married put on Goose today or 2 days ago. I buy stock at up 59.50. It was there a couple days ago, okay? And I go out to January. I would have bought the 65 put, we'll call it 11.50. Since the stock was at a lower price. Well, that's too high risk for me, but okay, let's call it 11. Sorry. I want to see that down below 8%. Normally it's when I'd open it. Okay. So, okay, let's get it 7.8%. Not bad. Now, if this was my position, and today with the stock moved up to 60.27, I decided now to sell the July. There's no premium there, really. But let's say I would have sold the 65 call in this case, because I don't want to sell a call below the put. That creates a bearish position. Oh, I should have done that differently. It's okay. It's okay. Let's reverse this. Let's call this 57.50. Sorry, I forgot where I was. Hold on one second. Okay. I am going to yell at someone in a minute. Don't worry, you guys won't hear it. Looks like someone, perhaps a programmer, is doing something in the background. One moment. Okay. You have... All right. Hold on one moment. Okay, let me just go ahead and undo this. It looks like programmer might be resetting something, and as a result, website is down. But let's just go back to the discussion. I can't get the graph for you right now, but let's say that I had a position where I had bought the stock at 57. I bought a 60 put and sold that 60 call when it was at 59, and now the stock is at, I don't know, let's call it, let me toggle over here. Let's see if I can get it in a second. If it's, in that case, my position would be different in the sense, Jamie, this is for Ford, but I'd have something that looked more like this. Okay, and this would be about $62, $61.50 maybe. And over here, this other lower break even might be around, let's say, 58. Okay, so I have a small window here because it's the first time I used an income method number one, first time I sold the call. So in this case, if now the stock's above that price, above my 60 strike, and I'm coming up into earnings, I don't want to risk it either way, because if it's a large gap down, I didn't really help myself, and it's a large gap up, I'm also in a loss. That's the time, David, I would buy to close this call, even though it's extra cost, and just either leave the married put open through earnings, or maybe add a cheaper put to sort of put in that strangle or straddle position. Okay? And so that's what I would look for, David. Now, if it does, as I mentioned, if you do get assigned because you leave the call in place, you could use income method number 7. If you roll up further out in time, you've given yourself some more room, but if it blasts through that short call, you may have to roll it again. So that's what we battle with in those cases. I prefer just not to have something open. You know, hindsight's 20/20. I did an income method number 12 4 months ago on Sony, and it didn't really do anything. And so I left 12 open until hopefully it moved. And then the next earnings came out and it did move a little bit more, but I'd wasted a lot of time premium waiting for that second earnings announcement with 2 puts in place. That wasn't the right play. The first Sony play, I should have done income method number 5, and I should not done income method number 5 on Goose 3 weeks ago, 5 weeks ago, 4 weeks ago. All right. Yeah, related to what Sam was, he was just going back and he was saying that, I'm sorry, what he was trying to say, that there are so many small caps today like GLMD, it was up $2 or 19%. So a lot of those small cap ones can swing wildly one direction or the other in that case. Rahjiv, unless the gap is big, it doesn't work. What Rajiv's question is, and it's, I'm going to try something here again real quick. Let me see if I can get in. Rajiv's question is, well, if you're in that short call position going into earnings and the stock gaps up, why not just buy an additional out-of-the-money call? Okay, good. We're back on track here. Sorry about that, folks. There we go. All right, so let's say we did, I'm going to stick with this one. And I said 57.50, 60 January put. It's now out of the money. I could roll it, but anyway, we just want to be in the proper structure. We said 480, was it? Oh, no, it was closer to $9 or $10, wasn't it? Okay. Let's try 950. I know these are not the right prices, but oh, that would have been for the 65. Yeah, so we got to drop this down to, let's try 750, okay? The time. Better, much better. Original married put, 7.7% at risk. Now, when the stock moved back up towards 60, I sold the 60 call, and I got 75 cents, let's say. So, I don't know, July 27th, doesn't matter really. We sold the 60 call. Let's give ourselves a little bit more there. Let's give ourselves 80 cents. Okay. And that was maybe when the stock was at 59.50. Now it's at 60.27. That would help, wouldn't it? All right. So good. We've taken our risk down to 6.5. We can still make 5.6, but now we've got two ways to lose. Above 71, I was too close. I said 62 if I'd done a weekly for only 30 cents or so. And 52.86. This isn't too bad of a range, okay? But you know if the stock gaps up to 71 or 70, it adds another 10 points. We're going to be here, okay? We've come off the 412. We're down here. Now, what Rahjiv is saying is one thing you could do, but I get nervous about doing this because everything's inflated now because everyone knows earnings is coming up. Earnings is not coming up on Goose. I'm just saying that if your stock is coming up to earnings, you know everything's inflated by this point. So what does that mean? Is that if I went out to that same expiration and bought a further out of the money, halfway, maybe between where it hits 70, 65 call for about 55 cents or so, we still have a decent position with unlimited upside. And that's okay. That looks good. I agree. But the problem is we took in 80 cents and we're buying this for 55. Okay? So that means the net here, oops, sorry folks, it's going to be 35 cents. Wow, 25 cents. My apologies. That's the net. The net premium to lower that initial risk, still down to 7.3%. Looks good. We don't cross into the negative again, which is what I wouldn't want to see. What do I mean by that? Is this dip came down to here and then came back up, as maybe the break evens over here. I wouldn't like that because even with a good earnings, 10% earnings. What's that? 6 points right here. 11% right here, 8% right here. Not doing good. Okay, that's not where I want to be. This might be okay, but you're giving up. This is probably only $20 to $30 of profit from about 370. Okay, so we're giving up some there, but we do have the infinite upside in case of a large gap up in price. Study the stock you're trading, David. Are you really expecting something that big of a gap where it makes it worthwhile up to 70 from where you are now? Right? That's almost a 20% gain. Not quite 20. Okay, it's a 15, 16% gain earnings. It's possible. And how much did you hedge downward if it falls? Right? Did you really take much of the risk off? Now, you're right, Rhajiv. If I just bought back that call that I had mentioned here, this 55 one, it was shown at about $2, I'd add to my risk, and I'd have a married put now with about an 8.9 or 9% risk after adding another $1.50 into the position to buy this back for about $2, right? The original call that I sold instead of doing this one. But then I could do income method number 4, roll up to the 65, and I might take this back down to 5%. Okay? Would it work? Let's see. I don't know if I'm quite near where I want. And David, you know I'm not quite where I want to be. Let's ignore this extra long call for now. The stock has moved up past your short call, which means it's also likely moved up past your long put. What does that mean? Let's buy back this call. July 60 at 220. All right, so we're losing $1.40. I'm adding $1.40 back into the position by buying to close that call. The risk goes up to 9.6%. But the stock's above 60. Okay, so I got to add $1.40 in here to calculate this. So we're going to go, our cost base is going to go up to $58.90 with a 60 put for $7.50. There's my 9.6% at risk. Okay, so I bought to close the call. This looks disastrous because if it falls now, I'm in trouble. Right? Do what Rhajiv says, we only had a risk of 7.3%. Leave the call open by itself, we only had a risk of about maybe 7.4% or so. Now, since the stock's above my strike, I could roll up. Looks like about $3 here. Almost, I'm sorry. We got to sell to close our original, buy to open the next one. So now I'm at 65 with only a 6.1% at risk. So I bought back the call and paid the money in, rolled up the put. I'm increasing, yes, my cost basis in this case, but I'm going through earnings with an unlimited upside at only a 6.1% risk, which is lower than any of the combinations we just looked at. Okay, so that's another thing to consider. You could also move it in depending on how far out your put is as well. It's another idea. Okay, so Rhajiv, is it better to buy it back or to buy the extra call? It depends on your outlook and it depends on your risk tolerance. Remember, by buying that new one, you're going to add to the cost basis on the position, so your risk is going to move back up. It does leave the upside open if there's a gap, but remember when we looked at that income method number 6, I want to make sure it doesn't go back into the loss area because that's probably a possible target where it is. Okay. All right, and Rhajiv says you're facing the same thing with Intel, and you did buy the extra call. That's great. But what I want to mention is let me know how that works out. Okay. Let me know how your position works out, Rhajiv, next week with the extra call. If there's a big earnings pop on Intel, of course, I'll be able to see that during the week as well if there's a big decline there. And we'll see what happens with a short call and a long call as well. Okay, so that's sort of the idea, David. What's the best answer? I don't know because I don't have a crystal ball. I don't know the future, unfortunately. None of us do. But when you're heading into earnings, make sure the current structure that you have, even if you have the sold call there, you can say to yourself that you're comfortable, David, with the current profit and loss chart if the stock gaps up 15% or gaps down 15%. Gaps up 10% or gaps down 10%. And then if you did an adjustment, if you thought about rolling up the call to a higher strike price further out in time to roll for a credit, look at that new profit and loss chart and say, what happens? Am I comfortable with this potential profit if my stock gaps up 15% or gaps down 15%? Am I still comfortable with this position if it gaps up 10% or gaps down 10%? Or it doesn't move. There's no change. Okay? And, you know, you could do that by just what Rhajiv said, David. You could play around on the profit and loss chart custom spread tool here with buying that extra out of the money long call, which is not a bad idea. I just don't want to see it to go back into the negative area. I always want to see it positive when we look at that income method number 6 play. As we mentioned before, let's see here. What did I have? 60 at 80, 65 at 55? Yeah. Okay, so okay, because this one we didn't take into account the other roll. Oh, I added the $1.40, and that's why. See, this is what I don't think I would want. Even though it just touches, I don't want this to be in an extra loss, because if the stock moves up 5.5 points, 8, 7, 8, 9% return gain from earnings, I'm at a loss. I don't want that. I don't want to be negative when the stock did what I wanted it to for a bullish position overall. Okay. Now that doesn't mean the trade is dead. You could roll this spread. You could roll the short and the long call. Perhaps you could make some adjustments, but I don't want to put myself in that position ahead of time. It'd be worse, naturally, of course. Let's just say I got this at 75 and bought this at 55. You probably wouldn't do it for this low of a credit. Now you see start dipping down a little bit lower because there's less premium. And there's not even much profit here to be had in this example, and that's solely because I put that 140 in from buying back the call, which we just put back in. So it's a profit of 115. That's not bad at 65, but if you left it open, if the upside was open and it went to 65, you would have had 5 points more profit. Both of this 115 profit and the 5 points I mentioned, that's including the put. Okay, so it moved up 5 points and excluding the decay on the put option if it moves up. Rhajiv had mentioned that he noticed today, or noticed this week, that Robinhood, you could do the spread trade in one go without any commission. And you tested it today. You were not aware earlier. I'm sorry. I thought we'd mentioned that maybe 2 weeks ago. I can't remember. Maybe it was 3 weeks ago. I saw their press release that said they were going to allow spread trading now at Robinhood on the different apps, as well as other multi-legged strategies. So yes, they now have spreads at Robinhood with the no commissions trading. And so for investors that are doing different things, or credit spreads, or more complicated individual spreads, they now have increased what they're doing there at Robinhood to allow for the spreads, which they didn't have recently. I think you have to leg into each position in order to create the spread, the 2 or 3 leg spread on the position. Okay, well, ladies and gentlemen, believe it or not, it's 5:25 p.m. Eastern Time. I do have one other question that has come in. I don't see any other questions right now, but I do have one other question that came in earlier. A phone call, actually, from a customer who was using the Naked Put weekly search. I just want to walk through this real quick. So we have the weekly picks of the day here. But the customer went into the main search for weekly picks of the day, and what he had done, he has about 6 or 7 other Naked Put searches created on his account. And of course, what he has done is selected to get those results by email. Okay, so what this allows you to do for different strategies is you can say, I want the weekly picks of the day emailed to me at 10 o'clock, so you don't have to log on. You can pick other times during the day as well. Or if I wanted my OTM screen with IV less than 70, webinar from August 20th, I can check to have those sent to my email at any time during the day or just at 10 a.m. Okay, so this is what the customer had done. He was receiving our weekly picks of the day search results via email at 10 a.m. All right, and you just click Save and Submit, or cancel all emailed reports. All right. What he didn't like is that based on the criteria we've used, and by the way, I back-tested all of this again for 2018, the weekly naked puts following Ernie's rules here in the weekly picks of the day screen. If you take the top 2 results that show up on Monday afternoon and place the Monday, afternoon, or 2 o'clock or so, 3 o'clock, place those 2 trades, and then you close them if there's a 7% drop in the underlying stock, or just allow them to expire. From April 2nd to today, it was a 9.4, 9.5% return over that 3-month period with the weekly naked puts. From January to now, it was only a 12.4% return. Okay, but that's still not bad for 6 months in. It might be a 24% yearly return, a little bit behind. But why did January to July, roughly almost 7 months, 6.5 months roughly, but why did January to July only have a 3% higher than April 2nd to, April 2nd to the last 3 months, April 2nd till today. And of course, the reason why is that from January till now, we go back 6 months. Let's see here. Oh, I had that was a discussion from last week. Oh, it's just daily. It doesn't matter. Okay, sorry, folks. I'm sorry. Well, you know what happened. In oh, I did go 1 year. I'm sorry. So if we went back testing from January, we had the February 5th to February 9th volatility crush and the March 21st to April 5th collapse, and a little bit of a hiccup here beginning of May as well. But just going from April to here, missed most of this March 21st. That was 9.5, 9.6% following the weekly naked puts, and 12%, 12.5% from January to here using the weekly naked puts, with SPY actually being down, so that's not too bad. In any case, here is the problem. The current results that are coming up, and then Mark says, yeah, because of the stupendous January. No, that's true. That was great, but January to now also took care of that big decline in February 5th through 9th. That's where the losses happened, and March 21st through April 5th. Just going from April to July was 9%. Add 3-4 months into it, and you only gain another 3%. It's because of the February 5th volatility, kerfluffle, Mark, and also the March 21st through April 5th tariff wars is what was going on in the market at that time. Fears of the tariff wars. Back to square one. Customer calls in and says, I don't like your weekly naked put picks of the day anymore because they're only half a strike out of the money. They're too close to the stock price. 1791, 17.5 strike here for Acorn. Turtle Beach 2358, it's at 22.5. Intellisat 2070, 20. Okay, well, it's because it's being sorted by the highest naked yield, and there's some high premium in these positions. I'm pretty sure I would ignore Acorn anyway. That looks too good to be true. Something's coming up. I don't know if it's a pending patent lawsuit, if they're involved somehow in an FDA approval with another company. That's just way too high. In any case, and we talk about that in the write-up, if you see something that looks too good to be true, you might want to do a bull put credit spread instead of just the naked put. But in any case, all taken care of. Okay. If you don't like what you see in our defaults, well, we've put them together, and we have those testing results that we show we've worked. And I showed you the testing results currently. But if you're not comfortable with them, that's fine. I can't promise that you'll see the same returns. But if you want more security, no problem. All we did is we went into his search, increased the percent out of the money from 2% up to 4%, and made sure the strikes were at least 3% of the money. Most of those have 50-cent strike differences, so at least gets you 1.5 points below the current stock. Kept everything else the same. The stock criteria that Ernie used for his back testing and for creating the picks of the day, time frame 0 to 8 days in this case, naked yield, all stays the same minimum requirements, but we're forcing it to go further out of the money. Okay? And not too bad. We still get some other things here with a 1.9, 1.1, PG&E, Whiting Petroleum, OLED at 0.8 for a 7-day trade. That's not bad at all. Okay? There's Canada Goose, 57.5 at 0.7. Not too bad either. It's only 35-cent premium. But it's a trade-off, meaning that if I force it further out of the money here, also looking for perhaps the higher probability ranges, I can't expect to get 80, 90 cents or $1 for an 8-day trade. So that's the trade-off. Still a good, reasonable percent return, but everything's below $1. Probabilities, 75, 74, 80%, all where you'd expect with going that far out of the money. So it's just a simple change. If you don't like what you see in the defaults that don't match, you think the strike prices are too close or not far enough away, for example, just make the changes to the criteria and then save it. So now I'm going to save this as Mike's Weekly Puts. This is not a recommendation or suggestion. It's just a way that illustration of how we would do this very quickly. And then I'll say further OTM for more protection and security. Okay? Now I'm going to save the search. Simple as that. So now every time I come back into the naked put screen, I can go to Mike's Weekly Puts, the webinar from August 20th, monthly, weekly picks. I could always go back to the defaults. The system will remember which one I stay on. So if I log out now, log back on Monday, it's going to pull up this search result. But what I want to do now, of course, is I want to go back into my account. And I'm going to click this email search reports. And I could have also done it from there by get search results for email. What I want to do is change what I had done before. So I'm going to go into naked puts here from the email. Oh, I didn't save it. So if I had saved it, of course, we would have had this selected and maybe the August 20th and this one as well. So what I'm going to do now is just uncheck those. We'll check Mike's Weekly Puts and save it. So now every day at 10 a.m., those results matching essentially the starting point of the weekly naked put screens that Ernie tested and put the criteria together. I decided to go further out of the money for safety, made some changes, saved it, and then readjusted my email, so now I can see my personal search emailed to me at 10 a.m. based on the weekly naked puts. Okay? So in any strategy, of course, if you don't see what you're looking for, just make changes to the criteria, and then you can select to have those emailed to you in the morning. Why do we start at 10 o'clock? Well, it's allow some time for the market to move. You can always log on ahead of time and look at your search results first thing in the morning, or if you're on real time or after the first data run comes through, or just get the email at 10 and use that as a starting point to research, then jump back in and see what the spreads or what the naked put premiums are when you're about to place a trade or place more trades as well. Okay, so I just wanted to review that very quickly. Conversation we had with a customer related to changing the criteria to match what you want in any strategy, but at the same time selecting to make sure that you can have those emailed to you. Mark says, if I'm not on real time, I would do this nightly. Sure, I mean, if you're on 20-minute delayed, you can still have it sent to you at 10 a.m. There's nothing wrong with that. It would still be updated data. The first data run usually goes through about 9:45, 9:50 mark, so you'd have close prices to what would have matched your criteria. If you're just using the end of day data only, the lowest subscription value, you can only have it emailed to you at the end of the day. It doesn't make sense to have it emailed to you at 2 o'clock in the afternoon because you're still looking at the previous day's prices. So I don't know if that would work for you with the end of day data. It's one of the things that you missed there is the timely updates if you're getting your searches emailed to you in the morning. A couple of my positions today, if I would have had the results of a covered call or a collar, what I normally trade, or a bull put spread, at 10 a.m. based on the closed numbers, all the positions I entered I wouldn't have even seen. They just wouldn't have been there. I would have seen positions that I couldn't get the premium I wanted, or the stocks had moved the other way for the pair of call spreads, and none of them would have been viable. The short call was actually in the money at that point with a couple of the stocks that I looked at. So I'd have, it doesn't help me save time that way. That doesn't really help me save time. But yes, Mark, you could have it sent to you at 5 o'clock in the afternoon if you're on end of day data, so instead of logging on and looking at it. But if you try to use that to place trades on Monday, or the following day, I should say, the prices are going to be subtly different as well. Okay, now, I think that was the last question I saw. We are at about 5:37 p.m. Eastern Time. I just want to remind everyone, of course, if you have not done so yet, remember you can just go to PowerOp.com, put in your name and email address, and click Start My Trial. We'll give you access to Power Options, no billing information needed for only for a 14-day trial. No credit card, no billing information needed, but you'll have full use of the site on the 20-minute delayed service. Speaking of which, there's the prices, the end-of-day service we were just discussing. It is only $40 a month, but you miss out. Oh, you do miss out on the search results by email, Mark. I'm sorry. If you're on end-of-day, you don't get that. You don't have that capability to have your results emailed to you. You don't have access to the picks of the day either. But on the $60 per month, you get those two, plus, of course, the data updated every 15 to 20 minutes. And as I mentioned, that's why I'd select my search to be sent at about 10 a.m. or at a time when you do your trading. And $100 for the 60-minute plus access to the full back testing suite of tools, the 3 or 4 tools there for historical testing with data back to April 2006. We do, of course, offer a real-time service and the premium, which includes real-time and the history as well. One of the education over the weekend, remember, just you can check out the blog at any time, blog.powerop.com. We usually showcase the webinars page. We didn't do that today, but you can find a lot of other strategy and tools videos, management techniques for various strategies, just at powerop.com/webinars.asp. Of course, you can also check us out on YouTube as well. Now, if you think of further questions later on this weekend or later on when you're thinking about what we talked about today, think of a question, remember, send me an email at any time to support@powerop.com or support@radioactivetrading.com. You can also call the office during market hours, 302-992-7971. And of course, if you're on a trial or if you're a current subscriber at any level of service, you can schedule the coaching session at any time. It's essentially a 35 to 45-minute phone conversation with myself or Ernie. We'll walk you through the tools on the site, answer any questions that you have about strategies, but we can't tell you what to trade or how to exactly manage your positions. We can show you the pros and cons of management techniques and which one, you can decide then which one best suits your needs, your goals, and your risk tolerance. Ladies and gentlemen, thank you again for joining me. Thank you for your fantastic questions. Thank you for being a part of our Friday sessions. I hope everyone has a fantastic weekend, and I look forward to seeing you next week with some of our other presentations. We'll have some blog articles up next week and some embedded videos, recorded archive webinars, and we'll have some other stuff for you next week as well. So take care, everyone. Good night. We'll get this webinar posted up on the page sometime this weekend or first thing Monday morning. All right, take care, everyone. We'll see you soon.